You know that feeling, right? That absolute gut punch when you see the market take a dive? But what if you could completely change that feeling? What if instead of anxiety, you felt, well, something else entirely? Today, we're going to talk about a really simple but incredibly powerful way to rewire how you think about market volatility.
We've all been there. You pull up your portfolio and it's just a sea of red. As those numbers drop, you can literally feel your stomach sinking right along with them. It's this universal, almost physical reaction to seeing your hard-earned money just seemingly disappear.
It's immediate, isn't it? And it feels personal, like it's a direct hit aimed right at you. That feeling, that pit in your stomach, is actually pretty dangerous because it can seriously cloud your judgment. It's what pushes you to make those rash, emotional decisions you almost always regret later.
Let's just call it what it is. It's panic. It's your brain's ancient fight-or-flight instinct just screaming at you to sell, get out, stop the bleeding, do something. But here's the thing. What if that instinct is totally wrong? What if it's all based on a huge misunderstanding of what's actually happening? Okay, so let's break down this old story we tell ourselves. Our brains are basically hardwired to see a loss like this as a punishment, as if we did something wrong. You start thinking, oh, I timed it wrong, or I must have picked the wrong stocks. It feels like you're being penalized for making a bad choice. You see, when you think of a market drop as a fine, it automatically triggers regret and fear. And why wouldn't it? A fine is what you get for making a mistake, for being wrong. It frames you as a failure, and that is a terrible, terrible headspace to be in when you're trying to make smart financial decisions. All right, so what if we just flip the script? This is the whole idea right here. Instead of seeing a market drop as a fine you have to pay, what if you saw it as a fee? It's no longer a punishment for a mistake, it's just the price of admission. Just look at the difference here, side by side. The old view, the fine, is an unexpected penalty because you messed up. The new view, the fee, is the known cost to get access to a valuable opportunity. See the shift? One makes you a victim, the other makes you an investor. It's a transaction, not a punishment. And this is the key. A fee is something you willingly pay to get something you want. You pay a fee for a concert ticket, right? Not because you did something wrong, but because you want to see the show. Well, think of market volatility as the fee you pay for a front-row ticket to the show of long-term growth. This quote just nails it. The stock market doesn't hand out the potential for those amazing returns for free. The price you pay for that potential is having to live through the periods when it goes down. You know, it's not a bug in the system, it's a feature. It's the cost of doing business if you want to build real wealth. So this all sounds great, but how would we actually use this new mindset? Because honestly, this isn't just some clever mental trick. It's a real practical strategy for staying sane and, more importantly, staying invested when the market inevitably gets choppy. So let's boil it all down. Fines are punishments. Fees are just prices. Volatility isn't a penalty you get for being in the market. It is the cost of access to the kind of growth you just can't get from safer assets. You don't have to love it, but you do have to expect it and accept it. And this is why all this matters so much. When the next downturn hits, and trust me, it will, this simple reframe is like your shield. Instead of your brain screaming, I'm losing money, I made a mistake, you can calmly think, okay, the bill for future returns is coming due, time to pay the fee. It keeps you calm and focused on the real prize, the long term. So I want you to remember this. The market is always going to present you with a bill from time to time. That fee for growth, it's unavoidable. The only real question is, when it comes due next, will you be ready to pay it?